If you had put just $100 into a simple S&P 500 index fund 10 years ago, you would not still have $100. You'd have roughly $420. Not because you were a genius, not because you timed the market, not because you found some secret Discord group run by a guy named Crypto Brad. You'd have more than quadrupled your money by doing something that sounds almost offensive in a world addicted to action. Basically, nothing. You bought a tiny slice of the biggest companies in America, and then you got out of the way while they kept selling iPhones, cloud software, burgers, medicine, chips, ads, and everything else people keep buying whether the news is optimistic or apocalyptic. That's the power of letting productive businesses work for you. Now, let me introduce you to Tyler. Tyler is smart. Tyler watches finance videos. Tyler listens to podcasts. Tyler says things like, "I'm just waiting for the market to pull back," or "I want to learn more before I start." Tyler has been almost ready to invest for years. And that's the trap, because in investing, the biggest mistake is usually not picking the wrong stock. It's waiting. If two people invest the exact same amount every month, but one starts 10 years later, that delay can create a gap of around $1.2 million by retirement in a reasonable long-term compounding scenario. Same effort, same monthly contribution, completely different outcome. That's why this video matters, because by the end of it, you won't just understand the stock market. You'll have a simple blueprint to start building your first $100,000 portfolio, what I call your minimum viable net worth. That's the point where money stops being decoration and starts becoming an employee. And unlike most employees, it can work 24/7 without complaining, negotiating, or asking for a standing desk. Let's make this simple. A stock is not just a blinking ticker symbol on a screen. A stock is ownership. When you buy one share of a company, you are buying a tiny piece of that business. So if you buy Apple stock, you own a microscopic slice of Apple, its cash, its future earnings, its products, its growth, and in many cases, its shareholder voting rights too. That's the mindset shift beginners need. You are not gambling on a line moving up and down. You are buying into a business. Think of McDonald's. When you buy a share, you're not buying burgers. You're buying exposure to a machine that sells burgers, rents real estate, runs franchise systems, and generates profits all over the world. That's a very different thing from, "I hope this ticker goes up tomorrow." Back in 1792, 24 stockbrokers and merchants signed what became known as the Buttonwood Agreement under a tree on Wall Street. That's one of the starting points for what became the New York Stock Exchange. So yes, the technology changed. The apps got faster, the charts got prettier, the nonsense got louder. But the core idea stayed the same. Humans want to own productive businesses. That instinct built fortunes before Wi-Fi existed, and it still works now. Now, let's talk about where investing actually happens. You need a brokerage account. Think of it like a banking app for your future self. A normal bank account is where your money sits. A brokerage account is where your money goes to work. And as a beginner, there are really two account types you need to understand. Number one, standard brokerage account. This is the flexible one. You put money in, you invest it, you can take it out whenever you want. No age rules, no retirement restrictions, just plain access. That makes it great for general investing. Number two, Roth IRA. This one is the tax advantage superstar. A Roth IRA is powerful because you pay taxes on the seed, not the harvest. Meaning, you contribute money that's already been taxed, but if you follow the rules, your investments can grow and qualified withdrawals can come out tax-free. That is ridiculously valuable. Imagine planting a tree, letting it grow for decades, and then the government says, "You already paid tax on the seed, the fruit is yours." That's why the Roth IRA is so loved. It's not flashy, it's just structurally unfair in your favor. And that's what good financial tools look like. Not exciting, just efficient. If you're a beginner, the easiest path is usually this. If you have earned income and qualify, prioritize the Roth IRA. If you want extra flexibility beyond that, use a standard brokerage account too. You do not need a finance degree. You do not need 6 monitors. You need an account, automatic transfers, and the willingness to be boring for a long time. Now we get to the part where people try to get clever. Should you buy individual stocks or should you buy ETFs? Here's the unsexy truth.
For most beginners, ETFs win. An ETF, exchange-traded fund, is just a basket of investments you can buy in one click. Instead of trying to guess which one company will dominate the next decade, an ETF lets you own many companies at once. That means less drama, less ego, less chance of blowing up your plan because you got emotionally attached to one stock. And here's the part people don't like hearing. Even most professionals don't beat the market over long periods. These are people with research teams, terminals, data feeds, analyst calls, and very expensive opinions. And still, over time, a huge percentage of active managers underperform their benchmarks. That's why I call stock picking the cleverness trap. It feels intelligent, it feels proactive, it feels like you're doing real work, but the market does not reward effort. It rewards discipline. The market rewards patience and punishes cleverness. So what should a beginner own? A simple version is the classic three-fund portfolio. VTI for the total U.S. stock market, VXUS for international stocks, BND for bonds. That's it. With those three funds, you basically own a huge slice of the investable world. Thousands of companies, multiple countries, different asset types. You are no longer betting on one CEO, one product cycle, or one earnings report. You are betting on capitalism itself continuing to function, and historically, that has been a very good bet. Now, does this sound boring? Yes. Good. Boring is underrated. Boring is how people quietly build wealth, while the exciting people are busy posting screenshots of their losses. Compound interest is one of those ideas that sounds simple until you actually see what it does over time. Here's the easiest way to picture it. At first, compounding looks flat. You save, you invest, you check your balance, and honestly, it feels underwhelming. You think, that's it? Yes, at first, because compounding is like rolling a snowball down a hill. In the beginning, it looks stupid, small, slow, almost not worth mentioning. But eventually, it gets big enough that the growth starts creating more growth. And then one day, the line that looked flat starts to bend, then bend harder, then go almost vertical. That's the phase people want without respecting the boring years required to get there. And this is why time matters more than intensity. You don't need to start rich. You need to start early enough for the math to become unfair. Let me give you one of my favorite examples. Grace Groner was a secretary at Abbott Laboratories. In the 1930s, she bought 3 shares of Abbott stock for $60 each. That's a total of $180. Then, she did something that almost nobody gets rewarded on social media. She held it. For decades, she reinvested the dividends. No drama, no rebrand, no mastermind, no trading course. By the time she died in 2010, those 3 shares had grown into more than 100,000 shares, worth about $7.2 million. That is the power of ownership, plus time, plus reinvestment. Not hustle culture, math. And here's the painful part for Tyler. A 10-year delay at the beginning of your investing life can destroy a massive chunk of your ending wealth. If you invest the same monthly amount later, you can wind up with roughly 64% less by retirement in a long-term 10% compounding scenario. That is brutal because it means the first decade is not just extra, it's the foundation. The market is one of the few places where doing something early and imperfect is often better than doing something late and optimally. So if you're waiting to become confident before you start, understand this. Confidence usually comes after action, not before it. So, what should you actually do in 2026 if you're a complete beginner? Here's the blueprint. Step 1, open the account. Pick a reputable brokerage. If you qualify and you're investing for long-term wealth, start with a Roth IRA. If you want flexibility too, open a regular brokerage account. Step 2, fund it immediately. Not next month, not after one more podcast, not after the next election, now. Even if it's just $100, your first investment is not about the amount, it's about breaking the seal. Step 3, buy broad market ETFs. Keep it simple. If you want the simplest route, start with one broad US or total market fund. If you want more complete diversification, use the 3-fund setup, VTI, VXUS, and BND. You do not need 20 positions, you need consistency. Step 4, automate every payday. This is where adults beat their own brains. Do not rely on motivation. Motivation is a flaky employee. Set up an automatic transfer for every payday, so the money leaves your checking account before your lifestyle expands to absorb it. Make saving the default. Make investing the default. Make discipline automatic. Step 5. Stop checking constantly. Your portfolio is not a Tamagotchi. It does not need hourly emotional supervision. If you are investing for 10, 20, or 30 years, then daily market moves are mostly noise. Watch your contributions, watch your savings rate, watch your behavior, but stop worshiping short-term price movement. Step 6. Obsess over your first $100,000. Your first $100,000 matters because that's when the machine feels real. That's the milestone where gains start becoming noticeable. That's when your money starts earning enough that you can feel the compounding. This is the grind phase, the part where it still feels slow, the part where most people quit. Don't. Your first $100,000 is the milestone you fight for by any legal, ethical, boring means necessary. Because after that, the math gets less cruel and more
cooperative. And let me say something that gets ignored in a lot of finance content. Investing does not only matter when your portfolio gets huge. Even $1,000 in an investment account changes the texture of your financial life. Why? Because it proves you're not starting from zero anymore. It creates psychological distance from panic. It gives you a little breathing room. Then $5,000 feels different. Then $10,000. Then $25,000. You start realizing that money is not just something you spend. It's something you deploy. That shift is huge, because once you stop seeing money as something that only disappears and start seeing it as something that can reproduce, your whole financial behavior changes. That's when the game starts, not when you become a millionaire, when you finally understand the rules. So here's the bottom line. The stock market is not a magic machine. It is not a casino if you use it correctly. It is not a shortcut to instant wealth. It is a tool, a slow, boring, brutally effective tool for buying ownership in productive businesses and letting time do the heavy lifting. The people who win are usually not the smartest. They're the ones who start, automate, ignore the noise, and keep going when it stops feeling exciting. That's the whole secret. And yes, it's unsexy, which is exactly why it works. The financial system wins when you stay confused, intimidated, and stagnant. So let me ask you, what's actually stopping you from investing right now? Is it fear of a crash? Is it not knowing where to click? Is it thinking you need more money than you do? Drop it in the comments. And if you want, we can run the math together. Your future wealth probably won't be built by one brilliant move. It'll be built by one simple move, repeated for a very long time.